Petroyuan is not replacing the dollar, and the proof is hiding in a set of numbers. Most people never line up in the same room. In November 2025, China pulled in about 12.43 million barrels per day of crude, a 27-month high, while refinery runs sat around 14.86 million barrels per day, and domestic production was about 4.31 million barrels per day. The math created a surplus of roughly 1.88 million barrels per day going into storage, the biggest in about 6 months. That should have been everywhere, because when the world's biggest crude importer is quietly stockpiling almost 2 million barrels per day, while the internet screams that oil will flip currencies and end the dollar, you are watching the real game in motion. You did that. You watched currency headlines like they were weather reports. You saved time. You saved attention. You saved yourself the boredom of learning how the pipes work. You paid for it by letting other people decide what the numbers mean for you. If you stay with me, you will get the one test that ends the Petroyuan argument in your head forever. And you will also get the money map that tells you which companies get paid when the world builds new rails and which companies get squeezed when the world chooses redundancy over efficiency. But before you can use that test, you have to earn it by learning the difference between a label and a warehouse. Because a currency headline is usually just a label. The warehouse is where power actually lives. Here is the first number that collapses the myth down to size. In November 2025, the renminbi was the 6th most used currency for global payments by value, with a share of 2.94%. Run that like a street-level calculation. If the world moved $100 of payment value, about $2.94 moved in renminbi. Now compare that to the story you keep hearing. You keep hearing takeover language. Takeover language would require takeover shares. This is not takeover share. This is a growing side lane. Now hit the second number, because payments are daily blood, but reserves are emergency oxygen. Global official reserves are about $13.0 trillion. In 2025 Q3, the renminbi share in those reserves was about 1.93%. That is about $0.25 trillion. $250 billion is enormous in human terms, but compared to the dominant parking lot, it is not close. In the same snapshot, the US dollar share was still in the mid to high 50s, which is roughly $7 trillion plus dollars parked in dollar assets. You did that. You enjoyed a world where one parking lot held the majority of the world's emergency savings. You saved simplicity. You saved low friction. You paid by becoming dependent on the rules of that parking lot. Now the third number, the one that tells you why the dollar can stay dominant even while bypasses grow. In April 2025, global foreign exchange trading reached about $9.6 trillion per day. And the US dollar is on one side of 89% of all FX trades. This is the crisis intersection. It is the widest exit door. So even if corridors diversify, even if some invoices change, even if some settlement moves, when the building fills with smoke, the crowd still runs toward the biggest exit. That is why the Petroyuan story keeps misleading people. They see one new side door and assume the main exit disappears. Now we can go back to the question that actually matters. If China is the biggest oil buyer, why is the renminbi still only 2.94% of global payments and about 1.93% of reserves? Because buying power is not reserve currency power. Buying power is leverage over terms. Reserve currency power is leverage over the warehouse. A buyer can demand discounts and settlement options. A reserve currency demands that other people store their wealth and collateral behind it. Those are different muscles. China's leverage comes from barrels and scale. In 2024, China imported about 11.1 million barrels per day of crude. Roughly 74% of its apparent oil consumption run that. 74% means for every 100 barrels China consumes, about 74 arrive from outside. That is not an ideological position. That is a supply security reality. And it is why China cares about the route, the price, the reliability, and the settlement terms. If you import that much, a small improvement in price matters. A $1 discount per barrel on 11.1 million barrels per day is about $11.1 million per day. Multiplied by 365, and it is about $4.05 billion per year. At $2 discount, it is about $8.10 billion. At $5 discount, it is about $20.25 billion. That is why buyers negotiate, not because they love a currency, because $1 per barrel becomes billions per year. Now, connect this to stockpiling, because stockpiling is leverage in physical form. A surplus of 1.88 million barrels per day is not just inventory. It is optionality. If global oil demand is around 104.4 million barrels per day, a stockpiling rate of 1.88 is about 1.8% of total global daily demand. That is a meaningful chunk of marginal flow being pulled into tanks. When the marginal barrel is being stored, it can change short-term balances, it can support bargaining power, and it can reduce vulnerability to disruptions. Now look at price, because price is the signal that turns stockpiling into a strategy. Brent started 2025 around $82.63 per barrel and traded down to about $60 in December lows. That is a drop of roughly $22.63 per barrel, about 27%. If you are buying 12.43 million barrels per day, that price drop is not just a chart. It is a potential savings stream on the order of $281 million per day compared to January levels. 12.43 million times 22.63 is about 281 million. That is why China buys when prices soften. That is why volumes can surge. That is why the currency headlines can be a distraction from the physical strategy. You did that. You watched price charts and thought they were only trade or toys. You saved the effort of linking price to national strategy. You paid by missing why a buyer with scale can force concessions that matter more than the currency on the invoice. Now we can talk about the invoice and why it is not the whole story. An oil trade can be invoiced in renminbi and still feed the dollar machine if the exporter immediately swaps into dollars for hedging form. Collateral for investing surpluses or for paying for shipping, insurance, and equipment that is priced and hedged in dollar ecosystems. This is why you need the label versus warehouse distinction. The label is the invoice currency. The warehouse is the currency of reserves, collateral, hedging, and crisis exits. Now, here is the number that tells you why the warehouse is hard to move. Official reserves are 13.0 trillion. If you wanted renminbi to be even 10% of reserves, that would require about $1.3 trillion equivalent held in renminbi assets. That is roughly 5 times the current 0.25 trillion. And it is not just about accumulating the units. It is about creating a massive stock of investable, liquid, trusted assets that outsiders want to hold, with credible exit doors under stress. Now let us look at the rails, because this is where the Petroyuan story becomes real without becoming a takeover. China's cross-border interbank payment system processed about 175.49 trillion yuan in 2024, up about 42.60% year over year. You can convert that at roughly 7.2 yuan per dollar, and it is about $24.4 trillion equivalent in throughput. That is not small. It is huge. So how can something huge be only 2.94% of global payments share? Because the global denominator is enormous. Because the main highway is still carrying most of the traffic. Because a system can grow quickly while still being a side lane. This is what early infrastructure growth looks like. A small percent of a gigantic world still means trillions in flow. Now translate that into market behavior, because flow creates jobs and profit. If bypass rails grow, hedging demand grows. If hedging demand grows, the companies that sell hedges and clear risks get paid. That is why exchanges like CME Group and Intercontinental Exchange matter. When FX turnover is 9.6 trillion per day, even a 1% shift in hedging and settlement patterns implies about $96 billion per day of activity, potentially changing instruments, changing maturities, changing counterparties. A tiny percent of a massive number is still massive. Now bring it back to the political layer, because viewers come for the politics but stay for the math. China does not need the renminbi to become the global reserve currency tomorrow to gain leverage. China needs settlement optionality in key corridors and enough rail capacity to make that optionality credible. Optionality changes bargaining power. If you can settle without touching certain rails, you can negotiate terms differently. You can reduce exposure to enforcement risk. You can reduce exposure to sanctions. You can create redundancy. But redundancy is not the same as dominance. This is the part people confuse because they want a clean story. Clean stories are rare. Systems evolve. Now let's talk about what other people do when they actually run money in this environment, because this is where you stop being manipulated. They don't bet everything on a single headline. They build plans that survive multiple outcomes. They reduce forced selling risk. They keep liquidity. They diversify by mechanism. They own some assets that benefit when the center holds and some assets that benefit when the edges grow. They treat currency regime changes like slow tectonic shifts, not like a movie countdown. You did that. You wanted certainty. You saved yourself from thinking in probabilities. You paid for it by being vulnerable to the loudest narrative in the room. Now we turn to the public company map, because you asked for names and you deserve an incentive-based view. Start with oil and energy. If China continues to import around 11 to 12 million barrels per day in stockpile during price dips, the suppliers and the logistics chain matter. The big integrated majors like ExxonMobil, Chevron, Shell, and Total Energies care because they sell into global markets and hedge in deep pools. They benefit from deep dollar hedging and standardized settlement, which lowers friction. But they also adapt to multi-currency corridors because they already manage multi-currency revenue streams and global treasury operations. Now look at China's own state energy champions like Sinopec and Petro. When a country imports 74% of its consumption, the domestic refining and distribution system becomes a strategically throughput. Numbers like 14.86 million barrels per day refinery runs matter because they define how much crude turns into products and how much can be stored. A change of 0.50 million barrels per day in throughput is 500,000 barrels per day, which is material at the margin. Now look at banks. If the world builds more rails, cross-border compliance and FX hedging become bigger businesses, the largest global banks like JP Morgan, Citi, Goldman Sachs, HSBC, and Standard Chartered have scale to invest in compliance and to profit from flow. If compliance cost rises by 100 million per year, that is survivable for a bank earning tens of billions, but painful for smaller players. That is how fragmentation can create consolidation pressure. Now look at the security and data layer. More rails means more endpoints. More endpoints means more attack surface. That is why cybersecurity names like Palo Alto Networks, CrowdStrike, and Fortinet can become more strategically important when cross-border systems multiply. And the data and screening layer becomes non-optional when geopolitics increases friction. Now look at payments. Visa and MasterCard thrive on cross-border volume, and a multi-rail world can increase routing and compliance costs. But it can also increase demand for trusted networks that can clear reliably. Specialists like Wise benefit when cross-border friction remains high because they monetize the difference between expensive routes and efficient routes. Now the parallel rail everybody argues about, stablecoins. Stablecoins can function as a digital dollar in some corridors, which means they can grow even if the dollar remains dominant. If stablecoins grow, regulated gateways like Coinbase can become important infrastructure nodes. But the risk is policy and cycle. None of these names are a guarantee. They are mechanisms. Mechanisms are what survive headlines. Now, you are ready for the one test that decides whether Petroyuan is a symbol or a structural shift. And in the next part, I'm going to give you that test in a way you can apply every month with 3 dials. And then I'm going to connect those dials to what it means for real assets, for energy stocks, for banks, and for the kind of portfolio behavior that doesn't get forced out when the world gets noisy. If this is already helping you see the game behind the headline, like the video, subscribe, and share it with a friend who thinks Petroyuan means instant dollar death, and a friend who thinks it is irrelevant because both of them need the same scoreboard. Now let's make the scoreboard so simple you can't unsee it. And here is the political trigger that makes those rails worth paying for. When a country watches hundreds of billions of dollars of another country's reserves getting mobilized, it learns a new lesson. The lesson is not that the dollar disappears. The lesson is that access can be conditional. The US sanctions list that banks screen against has over 17,000 names. That number matters because it turns compliance into an industry and it turns routing into strategy. If your trade has a non-zero chance of touching a restricted rail, you either accept that risk or you build a detour. Now, go back to oil and see why oil is the most emotional theater for this debate. Oil is traded in huge physical quantities, and the global demand number is around 104.4 million barrels per day in 2025. So when China imports 12.43 million barrels per day, it is about 11.9% of global daily demand by itself. 12.43 divided by 104.4 is about 0.119. Means one buyer can be more than 1/10 of the entire market's daily appetite. That kind of weight does not automatically mint a new reserve currency, but it does change negotiation. If you are selling into the biggest buyer, you will listen when the buyer asks for a different settlement option or a different pricing formula. But sellers still think in survival terms too. They ask a simple question. After I receive the yuan, what do I do with it? If the answer is, I can't hedge easily, I can't invest it in a deep pool of safe assets, and I might face capital controls when I want out, then the seller will treat that yuan like a hot potato. That is why you keep seeing yuan settlement discussed as a corridor tool, not a global replacement. Now put one more number next to the yuan payment share. The renminbi share at 2.94% is the global payments by value share, but payments share can move month to month. Reserve share moves slower because institutions change habits slowly. That is why the 1.93% reserve share is the more important long dial. If reserves stay near 2% for years, the warehouse has not moved. If reserves climb from 2% to 4% to 6% over multiple years while exit reliability holds in stress, then the warehouse is moving. Now, let us make the pipes real in another way. SIPs processed 175.49 trillion yuan in 2024 across about 8.2 million transactions. And the transaction count was up about 24% year over year. That tells you two things. Volume is rising and participation is rising. It is a road being widened, not a poster on a wall. And the absolute scale matters because even if the global share stays small, the corridor can become extremely important for specific trading partners. In 2024, China's top crude suppliers provided about 2/3 of its imports, led by Russia and Saudi Arabia, alongside Malaysia, Iraq, and Oman. So if those suppliers accept even partial settlement in yuan, the corridor effect can be meaningful. But a corridor effect is not a global regime. It is one lane getting busier. Now bring it back to your portfolio of the way real money managers talk as a margin and volatility story. Fragmentation is a cost shock. If a company runs at a 6% operating margin and an extra 1% of revenue goes to hedging, compliance, routing, and security, that is not a 1% problem. It is a margin problem. A 6% margin dropping to 5% is a 16.7% drop in operating profit. 1 divided by 6 is about 0.167. If a company runs at a 24% margin, a 1% shock is about a 4.2% hit to operating profit. 1 divided by 24 is about 0.042. That is why in a multi-rail world, high-margin businesses with pricing power survive better. Thin-margin businesses get squeezed. Now, connect that to sectors. Banks with scale can absorb compliance and turn it into a moat. Exchanges and clearinghouses can monetize hedging demand. Data and risk firms can monetize measurement demand. Security firms can monetize attack surface growth. And commodity intermediaries can monetize basis risk and routing complexity. That is why you keep seeing the same types of names matter in a fragmented world. CME Group and Intercontinental Exchange sit in the hedging layer. London Stock Exchange Group sits in a data and reference layer. S&P Global and Moody's sit in risk measurement and ratings layers. Palo Alto Networks, CrowdStrike, and Fortinet sit in the security layer. Glencore sits in the commodity complexity layer, and the big banks sit across multiple layers because they clear, hedge, finance, and comply. Now, you see the shape of it. The Petroyuan story is not a single event. It is a gradual build of side roads driven by incentives. China's oil scale is an incentive. Sanctions risk is an incentive. SIP's growth is a capability, but global payments, share and reserve share tell you whether capability has become dominance. And right now, those shares still say the dollar remains the main warehouse, which means the most dangerous mistake you can make is betting your life on a dramatic switch. The smart play is building a plan that survives a slow shift, a sudden shock, and a long period where the old system still dominates crisis behavior. And in the next part, we are going to build the 3-dial scoreboard that tells you what is real month by month. Then we are going to translate it into what to watch in energy stocks, banks, exchanges, and the assets people run toward when volatility spikes. So let us build those 3 dials now, because once you can read them, Petroyuan headlines stop feeling like prophecy and start feeling like math. The first dial is share. The renminbi was about 2.94% of global payments by value in November 2025. That means if the world moved $100 of payment value through the main messaging lane, about $2.94 moved in RMB and about $97.06 moved in other currencies. If you hear takeover, but the number is 2.94%, you are not watching takeover. You are watching early expansion. You did that. You saved yourself from the boring discipline of looking at share, and you paid for it by letting one dramatic headline feel larger than 2.94%. Now, here's the part that people miss. 2.94% is small as a share, but it can still be huge in absolute flow, because the denominator is the whole planet. That is why the second dial is capacity. China's cross-border interbank system processed about 175.49 trillion RMB in 2024, up about 42.60% year over year. APP can grow 42.60% in a year and still be a small pipe compared to the main river, because the main river started decades earlier and already runs through every city. That is what the first stage of a bypass looks like. You do not build a second highway by teleporting cars. You build asphalt, you add exits, you add signs, you add police, you add gas stations, you add repair shops, and only then do people start trusting it for daily traffic. Now, the third dial is parking. Global official reserves are about $13.0 trillion. The dollar share is about 56.92%, which is about $7.40 trillion parked in dollar assets. The renminbi share is about 1.9%, which is about 0.25 trillion. Renminbi share, and the story changes. 0.25 trillion is not zero, but it is not a rival to 7.40 trillion. If you want the Petroyuan story to be structural, you need to see the parking behavior change, not just the invoice language. You did that. You saved yourself the mental effort of separating payments share from reserve share, and you paid for it by treating every yuan invoice like it is a reserve revolution. Now, before we go any further, you need one more reality check that explains why this is so hard to change. Global FX trading averaged about $9.6 trillion per day in April 2025, and the US dollar was on one side of about 89% of all FX trades. That is the crisis intersection. That is the biggest roundabout in the world, and when a crash happens, people run to the roundabout with the most exits, not the roundabout with the newest paint. So the Petroyuan story is living inside a paradox. China can expand bypass capacity and expand corridor settlement while the dollar remains the crisis exit. That is not contradiction. That is how networks behave. Networks don't die because someone wants them to. They weaken at the edges when alternatives become good enough, and they keep dominating the center because the center is where everyone panics to. Now, let us bring China's oil leverage into the room, because this is where people confuse buyer power with currency power. China imported about 11.1 million barrels per day of crude oil in 2024, and that was about 74% of its apparent consumption. In November 2025, China imported about 12.43 million barrels per day, a 27-month high, and in that same month, the estimated stockpiling surplus was about 1.88 million barrels per day. That number is the quiet part, because 1.88 million barrels per day is not a rounding error. Over 30 days, 1.88 million times 30 is about 56.4 million barrels added. If your average crude tanker holds about 2 million barrels, that is the rough equivalent of about 28 tankers worth of oil added in 1 month. That is inventory behavior. That is strategic behavior. That is a buyer using a price window and a supply situation to increase. You did that. You watched currencies and missed barrels. You saved yourself from the work of tracking physical flow, and you paid for it by thinking this is only about a symbol printed on an invoice. Now, connect that to the political lever. If you are the biggest buyer and you take 74% of your consumption from imports, you are a price taker in the sense that you must buy. But you are also a negotiator because your volume is massive. Even small terms, changes become huge when they sit on top of 12.43 million barrels per day. If oil is $75 per barrel, 12.43 million barrels per day is about $932 million per day of gross import value. Over 30 days, that is about $28 billion. If a buyer negotiates a 2% discount on a $28.0 billion monthly flow, that is about $560 million in 1 month. So the leverage is real, but leverage is not the same as reserve currency dominance, because reserve currency dominance is not earned by being a big buyer. It is earned by being the place everybody parks, hedges, borrows, and escapes in a crisis. Now, the Petroyuan headline usually makes one specific promise. It implies oil being priced in RMB is the end. But oil pricing is a label. The real war is funding. Funding is who lends, who clears, who provides collateral, who insures, who backstops in stress. Funding is the warehouse. Pricing is the sticker. You can change the sticker in a week. You cannot move the warehouse in a week. And you can measure whether the warehouse is moving by watching reserve share. 1.9% of reserves is the current reality for RMB. If that number remains around 2% for years, you're watching incremental settlement diversification, not reserve replacement. If that number moves from 1.9% to 3% to 5% while the system stays open in stress, you are watching a real change. So here is the practical price test. Stated plainly, Petroyuan becomes structural only when three numbers move together. Payments share rises steadily above the low single digits. Reserve share rises steadily above the low single digits. And crisis behavior stops running back to the dollar intersection at the same intensity. If only one moves, the story is partial. If to move, the story is getting real. If three more of the world is changing regimes. Now let us talk about what other people actually do with this information. Because the people who run large treasuries do not trade memes. They build redundancy. They hold liquidity. They diversify counterparties. They shorten their vulnerability chains. They avoid being forced. Because in a system where the main rails still dominate but bypasses are growing, the most common failure is not being wrong. The most common failure is being early with leverage. You did that, you saved time by chasing the dramatic conclusion. You paid for it by risking your survival on timing. And timing is what this system punishes. Now we translate this into the company map and we do it with mechanisms and numbers, so it is not vibes. Start with the hedging and clearing layer because fragmentation increases hedging. If RMB settlement grows in some corridors while most corporate costs remain in dollars or euros, currency mismatch. If mismatch rises, hedging demand rises. Even a company with $10 billion of annual cross-border costs that faces 1%. Adverse currency move is looking at $100 million of impact. So treasurers hedge. And when treasurers hedge, volume flows to the markets that can provide liquidity and clearing. CME Group and Intercontinental Exchange sit in that plumbing layer. When volatility rises, derivatives volumes often rise. When currency mismatch rises, FX and commodity hedging demand rises. This does not require Petroyuan to win. It requires the world to become more multi-rail and more volatile. Now move to banks, because banks are the currency contractors. JP Morgan Citi, Goldman Sachs, HSBC, Standard Chartered, they make money on FX, on trade finance, on clearing, on custody, on compliance, on corridor expertise. If the world stays dollar-centered, they keep collecting tolls. If the world fragments, the toll structure changes, but the need for complex services increases. Fragmentation is not a charity event. It is a billable hours environment, but it is also a risking environment. More corridors means more compliance burden. More compliance burden means more cost and more regulatory exposure. So the winners in banking tend to be the institutions with scale that can absorb the fixed costs. If compliance spend rises by $200 million a year, a bank earning $20 billion in net income absorbs it. A bank earning $500 million gets squeezed. That is how fragmentation becomes a consolidation engine. Now look at the energy majors. Because Petroyuan headlines always drag oil companies into the story, ExxonMobil, Chevron, Shell, their revenues and profits swing with oil prices, not with invoice language alone. If oil is $60 versus $90, the cash flow difference is enormous. A move of $30 per barrel on 11 million barrels per day of China. Imports is $330 million per day of gross value difference. So for oil majors, what matters first is the price environment, demand, supply, and refining margins. Settlement currency matters at the edges, mainly through financing terms, sanctions exposure, and corridor access. In a world where China uses its buyer power to negotiate different settlement options, the majors adapt, but they still hedge and fund through the deepest pools available, which is why the dollar still matters even when the invoice changes. Now look at the commodity intermediaries, because a multi-rail world creates basis risk. Basis risk is the difference between what you think you bought and what you actually have exposure to. When corridors fragment, basis risk rises that can widen spreads for sophisticated intermediaries while punishing smaller firms. That is why names like Glencore come up in discussions about commodity complexity, not because complexity is morally good, but because complexity creates margins for the people who can price it. Now look at the data and risk measurement layer, because multi-rail finance increases the need for measurement. London Stock Exchange Group sits in the data and reference layer. S&P, Global, and Moody's sit in risk measurement and ratings layers. When the world trusts less, it demands more risk pricing, and risk pricing becomes a larger share of operating budgets. If a global firm spends 0.10% of revenue on risk and compliance in a smooth world, and that raises to 0.20% in a fragmented world, the spending doubled. On a 50 billion revenue base, 0.10% is 50 million. 0.20% is 100 million. That extra 50 million goes somewhere. It often goes to data, screening, compliance, tooling, and security. Now look at cybersecurity. Because rail growth increases attack surface. If critical infrastructure spending rises by even 10% on large IT budgets, that is big money. Palo Alto Networks, CrowdStrike, Fortinet sit in the security layer. A multi-rail world is not only complex, it is fragile. Fragility increases security budgets, and security budgets become less discretionary. Now, look at consumer and enterprise payment networks. Visa and MasterCard monetize cross-border volume in trusted rails. Wise monetizes cross-border friction by offering cheaper or smoother transfers. In a more fragmented world, routing and compliance complexity increases. That can increase demand for trusted networks, but it can also increase regulatory costs. So the payment layer becomes a mixed story that depends on corridor, volume, and regulation. Now look at the parallel rail. Everyone argues about stablecoins in many places. Stablecoins behave like a digital dollar for settlement where traditional rails are expensive or slow. That does not kill the dollar. It can extend the dollar's shadow. It can also create new regulatory battles. Coinbase is one visible infrastructure proxy for regulated access, but it carries policy risk and cycle risk. Now, step back. Notice what just happened. Most of these winners do not require RMB to replace USD. They require the world to pay an insurance premium for redundancy. That premium shows up as more hedging, more security, more compliance, more data, more clearing. And that is why the smartest way to think about Petroyuan is not as a single bet on a currency. It is as a bet on whether the world is becoming more multi-rail and therefore more volatile and more expensive to operate in. Now, you might be thinking, okay, if the story is gradual, what should I watch month to month so I am not chasing noise? Watch the same three dials. Payments share. If RMB stays around 2% to 3% for years, the story is slow. If it moves from 2.94% toward 5% and holds, the story is accelerating. Reserve share. If RMB stays around 1.9%, the parking habit is still small. If it moves from 1.9% toward 3% and then 5% while markets stay open under stress, the story is becoming structural. Capacity and participation. If SIPS keeps compounding at rates like 42.60% year over year and participation expands beyond China link corridors, the pipe is widening. But the pipe widening only becomes dominance when share rises. Now add the stress reflex dial. FX is $9.6 trillion per day. Dollar on one side of 89% of trades. If a crisis hits and the dollar share still behaves like the exit, that tells you dominance remains. If over time the dollar share in FX trading drifts lower in a meaningful way, that tells you the center of gravity is shifting. Now, let us end with the political angle, because Petroyuan is never just economics. It is diplomacy with a spreadsheet. China's import scale is leverage. 12.43 million barrels per day is leverage. 74% import dependence is leverage and vulnerability at the same time. If you need imports, you must keep lanes open. If you are the biggest buyer, you can negotiate. So China's strategy is not to flip the system overnight. It is to add options. More suppliers, more inventory, more settlement flexibility, more bypass capacity, and you can see that in the stockpiling surplus number, 1.88 million barrels per day in November 2025. That is a country buying optionality. Now, here is the most important personal takeaway, because this is where people blow up accounts. Do not confuse a slow structural trend with a fast market trade. A trend can be right and still be untradeable on your timeline. If you lever into a trend that takes 5 years and you only have 5 weeks of margin endurance, the market will take your position and hand it to someone who can wait. So the behavior that survives is boring and powerful. Keep liquidity so you are not forced. If you spend $3,000 a month, 6 months is $18,000. That $18,000 is not an investment return. It is freedom. Avoid leverage that cannot survive a normal drawdown. A 20% drawdown is normal across many assets. If 20% forces liquidation, your plan is fragile. Favor pricing, power, and margin. If a company has a 5% operating margin and costs to rise by 1% of revenue, operating profit falls about 20%. If a company has a 25% margin, the same cost shock is about 4% of operating profit. That is why quality matters more when the world is more complex. And diversify by mechanism. Some exposure benefits from stability and dominant rails. Some exposure benefits from volatility and hedging demand. Some exposure benefits from security spending and compliance spending. You are not trying to predict one switch. You are trying to survive multiple futures. If this episode is useful, like the video, subscribe, and share it with a friend who thinks Petroyuan means instant dollar collapse, because the numbers say it is not that simple. And share it with a friend who thinks Petroyuan is irrelevant, because the pipe growth and corridor behaviors say it is not zero either. Now, the final question for the comments, because this is the honest split in the room. What would convince you the Petroyuan story is real? Would you need RMB payments, share above 10%? Would you need RMB reserve share above 10%? Would you need a crisis where participants do not run back to the dollar exit? Or do you think the more realistic outcome is a multi-rail world where the dollar stays the main exit, but the bypasses keep growing and the cost of doing business keeps rising? Because once you answer that, you stop arguing about slogans and you start watching the only thing that matters. Shares, capacity, parking, and stress behavior.